Let me make sure that the chat is up where I can see it, and say hi to y'all, to all of y'all. Helen, how are you? Robert, everybody, thank you, thank you, thank you. All right, well, let's get started here. I am excited to go over this with you today because in my heart of hearts, I'm a teacher, I'm a trainer, I'm a coach. That's what I love to do. I love almost more than anything. In fact, I don't know, when people say that more than anything, it's used pretty ubiquitously, right? But one of the things I truly, truly love is helping somebody understand something that is, let's say, complex or a little difficult, where I've put in an effort to learn how to do it. And once I figure it out, even if it took me like a week to figure it out, usually I can teach it to somebody in a couple of hours. Or if it took me an hour to figure it out, I can teach it to somebody in 5 minutes. That's a skill, a quality, something that is, it's a gift, right? And when I say that, I say that in the sense that it's not anything that I deliberately tried to develop. It just comes from a passion of really feeling the need to help somebody understand something that otherwise might have been difficult. And part of it comes out of just that natural sense of when you find something that's really cool, you have to share it. You just have to. People don't discover something awesome and just sit there with a silly grin on their face. You look around and you go, hey, come here. Let me share something with you. Let me just tell you this. This was so cool. I got to tell you about it. That's just human nature. Okay. And I truly, truly feel that way. With that, I'm going to see if we can start this show out. So if you will, on the text chat, tell me if you can see the slides coming up right now. Oh gosh, come on. I've got stuff that's in the way. I can't see to get this started right here. There we go. How about that? There we go. So do you see the, you should be, the way this is set up now, there we go. So you should be seeing it in full view now, full screen view, and not the, right? Yes, perfect. Thank you. All right. So you guys, as always, we always want to remind you that we've got the disclaimer up here. I am not going to give you anything that you could turn around and accuse me of giving you specific trading advice. That's the whole point of this, guys. Not going to do it. And turn that volume off there. And so enough of that. Here is our schedule coming up. This is our calendar, and point you to all of the things that are coming up. Rob does an amazing job of having high quality, lots of it. Lots of content, and so take advantage of it. All right, why change directions? Now, guys, this is you're going to see where I want to go with this, but the fact is I want to do a backup. Okay, and when I say a backup, I want to do a quick review. Last time we got together, we talked about indicators, and so this is kind of just a test, or one of the things as a coach, as a teacher, I'm always curious. Every time we come back together in some kind of a session, I say, okay, do you remember what we talked about last time? And I know that as a student, you probably got tired of hearing that from teachers that would say that, but it's really important. Retention is about the most important thing, isn't it? I mean, it's one thing to give you good information. It's another that you hold on to it long enough to be able to make it actually stick. So I was going to kind of play around and test you and do a pop quiz and whatnot. I'm not going to do that, but I'm just going to try to reiterate some of the things, because repetition is the mother of skill. There are no leading indicators. The word is very, very misleading. Okay. The only true leading indicator I know of is insider trading. Okay. Inside information. Other than that, all indicators, all of them, no matter what they call them, they can call them a leading indicator. That's garbage. Really, it's from a technical standpoint, it doesn't lead anything. Nothing leads price. Price is live, and things will influence it, but indicators don't lead. All right. They're like contrails coming out of airplanes. They're like sparklers when you wave a sparkler around. You know, all you're seeing is what's coming behind the action. How much weight do you put on indicators? Well, the fact is you only put in as much weight as they deserve. How do you know that? Well, you look at recent past. The accuracy of that indicator at predicting whatever it's supposed to predict, right? Or foreshadowing whatever it's supposed to foreshadow. The accuracy over the last 6 months is a lot more important than the accuracy a year or 2 or 3 years ago. And so if something has been accurate in the last 6 months, then you could lean on it a little heavier than something that hasn't been very accurate for the last 6 months. How many indicators should you follow? Well, don't overload yourself. You know, this poor fellow's got too much information going around, spinning around in his head. Guys, there's a ton of indicators, almost 100 of them. You don't need to follow all of them. So how many? Well, I don't know. Try 1 or 2 and maybe add another one. But personally, I don't use more than 3 or 4 ever. And that's simply because you try to find the ones that will best model what you are trying to discover. If you're using too many, it's because you don't really trust what you're looking at and you're just grasping, trying to hope that something will work. So which ones are the best out of all of those? Well, the question is, I don't know. Really, the one that is best is the one that works for you. And that will be a function of you being able to find one that is fairly accurate at predicting the next movement. It doesn't lead it, but it predicts. And guys, predictions are just that. I mean, our weathermen predict and weatherwomen predict all the time, and some of them are horribly wrong, but they still predict. Now you want to find the ones that are the most accurate. Okay. Remember, there are 4 types and 2 types of indicators. The 4 types designation would be there's trend following indicators, there's oscillators, there's volatility indicators, and then there's support and resistance indicators. That's one classification of 4 types. But there's also a way to look at indicators in the context of 2 different types or 2 different categories. One is overlays, like moving averages, Bollinger Bands. They're overlays because they're drawn up in the window right over top of the price. They're overlaid on top of the price. And then you've got oscillators, things like MACD, RSI, stochastics. Those are drawn in separate windows because when you draw them on top of the chart, they're not really designed as an overlay, because that's not where you are intended to use them. However, that said, I love doing it. I love putting MACD right over top of the price. There's some things you can do with it that are kind of fun, and the same thing with RSI and stochastics. But typically, you're going to see them in an outside window like this. Down at the bottom, you've got MACD and stochastics. And remember, both of these, in fact, most indicators, not all of them, but most of them have a function of having value when they contradict what is happening in the chart. So if you can follow my mouse, we pointed out last time that this big correction right here, this big correction right here where the red arrow is, where we broke a several month uptrend, was foreshadowed by the fact that the MACD did not post a higher high. That MACD right here, when the stock moved up and posted a higher high, MACD did not, and then trailed off, and the green line crosses the red on the signal when it broke the trend line. When you look at stochastics, stochastics basically follows the stock, and the biggest value of stochastics is when it diverges. Well, you can see right here, it did not diverge. It basically just followed the pattern, but it confirmed it. All right. Stochastics did give you an interesting signal right here where it flat topped. And when I say flat top, stochastics only goes to 100, and it goes from 0 to 100 positive, 0 to 100 negative. Same with stochastic, or same with MACD. And if you get right up against the top and it pancakes, it'll just go flat. Okay. And when it goes flat, it's like a pedal on or like a speedometer that only goes to 120. And when you hit 120, maybe your engine's been souped up and the car keeps going faster and faster, but the indicator can't show any higher than that. Stochastics will get up towards the top and the stock may continue to move up, but it may go flat. That is not a divergence. So you can see here, the stock continued to throw higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And right through here, it just kept going higher and higher and higher. Well, stochastics was simply agreeing with it by saying, hey, I can't show you any stronger signal. It's good. It's good. Yeah, but you're going flat while the stock's going up. Yeah, that doesn't mean negative. Look at MACD. MACD kept going up and up and up and up. It was confirming what was happening. And so stochastics also confirms when it flat tops because it can't show any higher. It doesn't go any higher. Okay, move over here. In this situation, however, stochastics starts throwing lower tops, lower bottoms, lower tops, lower bottoms, while the stock is pushing higher and holding up. The stock is holding up and pushing higher and stochastics going, yeah, I don't think so. I think you're going to run out of gas. There's just, you're looking good, but something is not right. And boom. And you had the same thing with MACD, or right up here, MACD, as the stock is pushing higher highs, holding, trying to break out. And you know, the bulls are looking at shooting back up here to equal this previous performance right here. But MACD is going, yeah, I don't think so. And Stokes is going, yeah, I think no, you look good, but there's something wrong. And boom, sure enough, down it goes. That is the value of those type of indicators. As you get to learn how they work, as you get to see which ones work consistently over the last 6 months or last year, that's where the value is going to be. Now, with MACD, you get 2 or 3 good divergent signals a year, typically, not always, but typically, if it's a strong, good correlated MACD, you'll get 2 or 3 really good divergent signals per year. So it's not something that's going to guide you on a weekly basis. It's going to be major trend or major pattern reversals that it's going to help you with. Stochastics, similar, but you can wind up with more signals with stochastics. Not necessarily, but for example, right here, look at this strong bullish run. Boom, 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 boom. Look at MACD, higher, 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 all the way up. Stochastics gets up and it plateaus. But you can see it starts to fall off too. So right here in June, even though we're pushing to higher highs, all-time highs right here, stochastics is going, yeah, something's wrong. I'm getting tired. I don't think this is gonna last. Okay, that means it's a reversal. Maybe it could also be it runs out of gas. In this case, it runs out of gas. In this case here, it was a major reversal. Here, it just ran out of gas, traded into a wedge, and then pushed up a little bit higher. Okay. But all it is saying with stochastics and with MACD, when they start to give you a disagreeable signal, it's saying, I don't agree with what I'm seeing. Oh, that means it's going to reverse. Not necessarily. It's just, I don't agree with what is happening. It's showing you a different message than what the stock price is showing you. Is this right? Well, no guarantee, but if it's been right 6 out of 6 times, well then, yeah, you could lean on that. If it's been right 3 out of 6 times, well then it's a crapshoot, right? Throw something up in the air and hope it sticks. So that's how you utilize indicators in general, guys. I just want you to remember these things. I want it to correlate to something that you can use a week from now, 2 weeks from now, 3 weeks from now. Okay, I was told that you didn't see my mouse. I am sorry about that. I don't know exactly how to fix that. But now we're going to shift directions just a little bit and go back into some chart patterning techniques. Because almost all of the indicators, their greatest value is to confirm what the stock is doing, which I say that tongue in cheek because how much value is that? If you're following the price, if you're following the stock and you've got some yeah, but or some me too's going, you know, you're saying, well, the stock looks really strong. And the indicator is going, me too, I agree. That's okay, but it's not terribly valuable because you can already see it. Okay, they're just yes men in that terminology. They're just agreeing with it. Okay, fine, you agree with it. But when they disagree, that's significant because if there is a reversal or if there is a turn, you stand to make good money or get killed. one of the two. And that, in fact, is the art of trading, is to be able to pick changes of direction. It's one thing to flow with the stream. That's not really trading. That's just sitting there in an inner tube going down the river on a nice day. Okay, not terribly hard, not terribly complicated. It's being able to know when to get out just before the waterfall shows up that you didn't see. Okay, turns and reversals are very, very powerful. It is an equilibrium, or it is a non-equilibrium or an out of balance scenario. That's what you're looking at. Equilibrium is stasis. It's where something is normal. There's no ruffling of the water. It's laying nice and flat. Everything is hunky-dory. Without outside forces, without a wind blowing, without an earthquake, without boats racing around on the lake, the water lays flat. Okay? And when things are static or in stasis in the market with traders, prices tend to be flat. You don't get a lot of price movement. Forces that can influence that on the water, like I say, wind, boats, earthquakes. When it comes to stock pricing, trading, the forces that move that is buying and selling pressure. Guys, if there was no buying or selling a stock, an issue would be delisted. If there's no volume, they would simply retire it. They would take it off. It wouldn't be traded. If nobody wanted to trade it, it would not be in the market. Okay? There's always buying and selling. When buying and selling are in balance, when the pressures are in balance, prices tend to stay range bound or almost flat. Catalysts. What are the things that will trigger an imbalance? Guys, it is almost, I don't know how you can make an exception. It's news. It is a perception that there is something different going on that provides a catalyst to imbalance buying and or selling. The only exception on that is perceived news. By that, I mean speculation. Someone might look to manipulate a market or manipulate a particular stock. They can either, one trick that is utilized, it's not legal, but it's utilized quite often, and that's news, to create some sort of a news idea, create a rumor, which is news. It may not be right, but it's news. So that can be manipulated, can be created, or just pure speculation by people thinking something's going to happen. So they'll go in and start buying, or they start selling. If it is outside of the norm, it can start to cause an imbalance. In fact, it will cause an imbalance. Okay. Price movement then is when there is an imbalance. When buying pressure or selling pressure is not equal to each other. Now, this may or may not sound like I'm talking to you as a third grader, but boy, oh boy, you better catch this. And do not resent or do not resist the idea that I'm making this very, very simplified. Complex things are often simple at their core. Price movement that you trade, that everybody trades, is simply imbalance between buying and selling pressure. That's it. Trading happens when buyers and sellers agree and they trade. Even when there's an imbalance, there's a point where buyers and sellers agree. If there is a trade made, there was an agreement. Okay, at that moment in time, the buyers and the sellers agreed. But if there's stronger buying pressure or stronger buying or selling pressure, the next price that is traded will likely not be the same as the last, because someone will bid up or down the price. Someone will be willing to sell higher or lower than the last person. Someone will be willing to pay a higher price or pay a lower price than the last person. And if there's a bunch of the on one side and not very many on the other side, the price will start moving. And it will move until the momentum runs out. Price moves tend to create volume because it's trading and trading volume. And if there's balance and imbalance, either buying or selling, it will create additional volume temporarily. When that bubble, and it's like an egg going through the snake, when that bubble of buying pressure subsides, price movement stops moving. If it was buying pressure, it stops moving to the upside. If it's selling pressure, it stops moving to the downside. It's when there's a pressure imbalance that the price will move higher or lower. Now, this is important for you to understand because when you're trading against the psychology of all the other traders in the market. You're trading against forces that you can't see. You don't know what the news is sometimes. You don't know what the motivation is sometimes. All you can see is price movement. But if you understand what price movement is, you will recognize a few key things that will help you on turns and reversals. Okay? One, that when you see price movement stop moving, watch for volume to change. In fact, when price is moving, watch for volume to change. Because sometimes as price is moving, particularly if moving to the upside or downside, I guess it's probably equal. I don't know for sure, but I think it's equal. When price is moving, let's say to the upside, if the volume starts to slow down, the price movement will follow. It will follow. It has to, because it's the strength of the imbalance that is driving people to pay more and to sell into that. When people are competing to buy, they will buy at a higher price. So if someone transacts at a certain price and they see there's lots of buying pressure, then the market will raise that price to see if in fact the volume will still be there. You would do the same thing if you were selling things out on eBay and you couldn't keep up with the orders. You raise your price. And if they keep buying it, you raise it again. And if they keep buying at the same rate, you raise it again. And then you raise it and the prices, the volume starts to slow down. And you raise it again and the volume backs off even more. And now you're going, wait a minute, we were doing better when we were selling at a lower price because the volume was there. Maybe we should lower the price. You back off the price a little bit and maybe the volume starts to pick up. So now it becomes a question of, do we drive the price higher or do we go for volume, right? The markets are constantly in that same kind of fluctuation. And there is that game being played out and you don't see it. I mean, you see it, but you don't hear it. You don't know the details. You don't know who's doing what. But if you understand the motivation for driving price and having it imbalance and out of balance, it'll help you with understanding behavior at the turns. Keep in mind, guys, and it isn't 50-50, but it is significantly close to that. There's about half the market that likes the stock to be trading in a sideways, range-bound fashion. And it may be for a long time or a short time, but they like that. There's motive. There's reasons why that's of value to big traders. There are other traders who want it to move, either up or down. They really don't care. They just want it to move because they are trading strategies that will make them money on price changes. Other people may be trading where they want the price to stay still, stay stable. That's the strategy I'm using. I want the stock to not move very much over the next couple of weeks. So you're always facing that kind of differential in motives of traders and big traders. And you will see in stock prices, and you'll see it when you look at their pictures. When you look at the shape of their trading, their history laid out on a chart, you will see if this stock is being driven by people who like to change the price, or if there's lots of news that makes it volatile, or if it is something that is more stable. and spends a lot more time resting or trading in tight ranges. And you simply, if you can identify that, you simply, if you want to trade it, you then have to tailor your trading to that behavior. But you got to recognize it and recognize what the motives are. So change in direction equals change in selling or buying pressure. Volume is not a universal component. You can have volume confirm what you're seeing in the chart, or you can have volume disagree. It can be contra. Volume is sometimes very significant, other times it's totally irrelevant. If you cannot make sense of the volume, if the volume doesn't seem to correlate to price movement, don't strain trying to figure it out. If it's not there, it's not there. Sometimes it is. If it is, great. Again, if you're going to try to use volume as any kind of an indication, you better be able to look back over the last 6 to 12 months and show that that's a valid concern. I'm going to jump ahead and show you something right now. You see volume spikes in this particular stock. Are they significant? You can see if you kind of visualize through the middle where your average volume is. And when you look at average volume, you see regular bursts. Can anybody see any correlation with volume? So I want you to participate here. Just look at this and see if there's any correlation in volume that you can identify. Does volume associate with any particular type of movement over the course of a year on this stock? It's there. You may not see it right away. Gerald says selling. Exactly. Good observation. Anybody else? Anybody else see that? Higher volume at the dips. Yes. Good job, Will. So you can see when the stock turns and heads down, volume shoots up. And then it tapers off, comes back to normal. And it stays normal. So you don't have huge volume when the stock is moving to the upside. In fact, look at the middle of the chart. The strongest upside move went for 3 months. Oh, call it 3.5 months. You got 3.5 months of strong upside movement without a significant fallback at all. And the volume drops off. What does that mean? Well, it means this is an optimistic group that feels comfortable, right? Well, this is the cues. This is the overall market, guys. This is the S&P 500. This is a way to look at the S&P 500 through the eyes of the 100 strongest NASDAQ stocks. Okay, I said S&P, I meant NASDAQ. When you look at that, 1, 2, 3.5 months, when the stock is moving strong, everybody is happy and they relax. There's no panic. There's no exorbitant speculative bursting that goes on here. This is comforting to traders when it's going boom, 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 boom. This is what they expect. And when it's going up, everybody feels happy and they calm down. It's when the market, and this is an overall market indicator, when it turns to the downside, that's when people freak out. That's when you see big volume. And you'll get a lot of positioning that goes on. Positioning meaning jumping out. But then that bottoms out. The volume starts falling back to normal. As soon as the stock or the market starts moving to the upside, as soon as it establishes a reversal, the market drops back. Okay? That is simply a way to utilize volume. Sometimes it correlates, sometimes it doesn't. Evaluate it individually. In other words, look at the stock and determine whether or not that indication that you're looking at, in this case volume, is relevant. Is it relevant? Well, in what's the context? Well, over the last 6 to 12 months, does it correlate to anything? And if it does, how closely? How does it correlate? All right, the next one. Trading should not be gambling. Guys, it basically it is, in that you can't control the outcome. You can't cheat. You really can't. Another correlation to gambling would be the person you're playing against, in this case, the rest of the market, however, individually or as a market, does have tells. So if you were gambling, one of the things you do is you try to learn how to read the behavior patterns of the rest of the people in the game. You know, is there anything they do that tips off what they're really thinking or what they might be starting to do or about ready to do? And that's what indicators are. If you're looking for reversals, changes in direction, if there are any tells in that stock or that index, it would be really advantageous if you knew what they were. And so you've got to learn how to use those indicators in order to help them with changes of direction. And that change in buying pressure and selling pressure can show up in volume. That is one of the things that shows up is volume. However, as I pointed out, it doesn't necessarily correlate. It can, but it may not. So don't lean into it too hard and assume that it's always, oh, when big volume shows up, that means, nah, you don't know what that means. Guys, you really don't know what that means. Manage your risk. That's always good advice. Now, there's a whole, gosh, a lot of lessons, a lot of time could be spent in teaching you the techniques for managing your risk. However, a couple of points to remember. The odds can favor good risk management. If you employ risk strategies, risk management strategies, risk mitigation strategies, in the end, it pays off. It always pays off. But remember, and every time that I ask this question, and I've done it several times, Tripp is usually one of the ones that jumps in first because that's something that he learned a long time ago. Your odds are never better than 50-50. No matter what your indicators say, no matter if an indicator's been right 6 out of the last 6 times, the odds that it will happen this time are still 50-50. Well, that doesn't mean that the indicator is not valuable. It's very valuable. But you just have to be prepared that it's not a guarantee. And anytime it's not a guarantee, the odds are 50-50. Yeah, but it's been right 6 out of the last 7 times. Okay, how do you know? Now, I could go forward for the next 6 months and still be right the next 6 out of the next 7 times. How do you know this next time isn't the 7th one? Oh, see, you don't. If one of the next 6 times or 7 times, if one of them was going to fail, how do you know it's this one or the next one or number 3 or number 6? You don't. But that does mean that your odds are very strong. So that plays into your risk management strategy. You would deliberately then set your position favoring that potential to be right. But your risk management is where you set your stops to protect in case it is not the one. If this is the 1 out of 7 times that isn't going to work, what if that happens? What am I going to do? And am I okay with that? You have to have that built in, and it's based around the 50-50 assumption. All right. So I showed you this one as a volume correlation. Let's look at this one right here. Is there anything that you can see on this chart that would indicate how it may behave over the next 1 month or 2? Now you're looking at a year. I want some participation. Is there anything you can see that would give you any indication of how it's likely to behave over the next, and each one of those vertical lines is a month. So over the next 2 or 3 months, is there anything that would give you an indication as to what might happen? I'll let that hang for a minute, and I'll ask you to look at the chart again very carefully and see if there's anything that you can see that happens repeatedly. Is there anything, any repetitious behavior that you can spot that's significant? Okay, a lot of gaps. That's been brought up 2 or 3 times. Islands. Island is when you have a gap and you trade for a while and then you gap someplace else and trade to there. What is that connected to? What do you think the gaps are connected to? Can anybody see any correlation? I'm agreeing with you, but keep digging. There's more. Seasons? Maybe. What season? Go deeper, Will. What do you mean? Jonathan has an interesting thought. So does Gerald. Earnings. Aha. See, if you look and start counting, look at this big gap here towards the, if you can't see my mouse, wait a minute. Let's see something here. Aha. Can you see this? I'm drawing on the screen. Anybody see this? I drew a circle. Yay. Okay, good. This is an island. I agree. But you see, 1, 2, 3 months, and then we gap. Go backwards on this last one. 1, 2, 3. Is it possible that the earnings aren't exactly 3 months apart? Absolutely. You'd have to look at the calendar. Here we go. 1, 2. So we have an announcement that's about 2.5 months and then 3.5 months. Right here. 1, 2, 3, and a week. Okay. So this company, which is F5 Networks, their earnings are not exactly 3 months apart. They're not necessarily quarterly. They're announced, and sometimes they push them out a day, a week or so. Sometimes they do it a little early, but these are all earnings. So where are we at? 1, 2, see this little E down here? We have earnings coming up right here. What would you anticipate might happen with F5 Networks? And if you set a gap, yay, good for you. Because that's exactly right. It is news, but these are gap related. That's the news. So you would anticipate that based on the last year, there's going to be a gap. It might gap up, it might gap down, but there's likely going to be a gap. Okay. So with this stock, if you were trading it, you would have to allow for being careful around earnings time because this stock tends to gap. And if you're in a position that's a one-sided position, it's a crapshoot. You don't know if it's going to gap up or down, but it's probably going to gap. So you better be prepared for that. Okay. What else can we observe? Well, we can observe that we were in a trend right here for 1, 2, 3, 4, 5, 6, almost 7 months, an uptrend. Then we gapped down. This went 1, 2, 3 months in a tight trading range, a little rectangle. Then we gapped up and we topped out at exactly the high that we had before. And we pulled back and we're in a trading box again. If there's an upside gap, it's likely to be up here and then move on from there. If it's a downside gap, it would drop down into this box, this next rectangular box, if it follows the pattern. Now, as much as I said 50-50 is the rule, and it is, careful on the words because words can mess you up in your subconscious. I can tell you that exactly what will happen. I can say this stock or this index, whatever it is, I can tell you exactly what it will do and still be completely neutral. I can be 50-50, completely neutral, and tell you exactly what it will do. How do you do that? And it's important. It's important that you know how to understand this and apply it. You can say definitively, this stock will do X if it follows the pattern. Now I can be very demonstrative. I can be very deliberate. I can be very confident and still be 50-50. And I set up my trade with my trade management, my risk management based on that statement. If it follows the pattern, it will do this. And if it does, this is what I will do. And if it doesn't, this is what I will do. You see, I'm totally confident and deliberate in my trading and still 50-50. You have to be that way, folks. You have to set up conditions. I will trade this, and if it does this and follows the pattern, then I'll do this because it has a pattern, because it's done it 5 times or whatever that is. Okay? So you do that very deliberately, but you always have to be neutral. Does that make sense, guys? And I really do want some feedback on that because I summarized a number of very critical points there. Does that make sense to you? I mean, and hopefully, do you agree with that, or can you agree with that? All right, excellent. Let's take a look at another one. All right, so here's Google. Guys, for the last almost a year, Google has had a almost vertical run. Okay, this is pretty spectacular when it gets right down to it. We can look at this and we can draw a trend line on Google that goes something about like that. Okay, we can see that if we go up to the first set of tops, which is right here, second set of tops right here, third top right here, what we see is there's a correlation right through here. There's a correlation right through here. For 1, 2, 3, 4 months, Google followed this angle of attack right here. And then it changed because of this. We broke out with a strong gap, an earnings gap up here, and we kept the same angle of attack. And then we dropped back down to here and started up again. We never made it back to the original baseline that was started at this change of direction down here, which means we start a new angle of attack that goes just like this. And now we lay these tops in, and that's a nice parallel line. And we have a beautiful thing. It's a secondary run on a bullish trend. So we had a bullish change of direction right here. Then we have a secondary run that brings that up. This, when this change happened, we've gone now 1, 2, 3, 4, 5, 6, 7 months. We had iterations or rotations on this. Let's do this right here. We had on this 1, 2, 3, 4, 5. Patterns tend to go 3 to 5 times before they break down. Here we had 1 rotation, 2 rotations, 3 rotations, and it broke to the upside. Okay. And when I say break down or break up, they simply change. Then we changed on this new angle of attack, and we go 1, 2, 3, 4, 5, and then it breaks down. When it breaks down, the normal pattern is to fall back to the last significant pattern. And that was this. And it's exactly what's happened. Now we're forming a wedge. 1, 2, 3 tops down, all the way back down to the baseline. And we're coming up on earnings right here. This is beautiful. So what is Google going to do at earnings? If it follows the pattern, it will move to the upside off of this base. And there will be obvious targets. The first big target will be to take out the previous all-time high. And then it will be to extend to the top of the new trading range, the angle on the trading range. Okay. If it doesn't follow the pattern, it'll break this pattern, which has been going for the better part of a year. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months. So there's 1 year exactly on this uptrend. If it breaks down, it'll break a 1-year uptrend. Support levels will be here, 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 here. Technically, worst case scenario, all the way back to the starting point. But on a retracement, and if you look at this as a bullish run, guys, on a bullish run, this is the first duration. This is the first, again, you put it in context, you can change the time frames. This is the first run. If we have a 25 to 30% pullback, it could pull down here and then leg up again. On the big pattern, the long-term pattern, what we're looking for is a pullback. We don't have a pullback yet. We've simply returned to the baseline. We have to break down. If it breaks down, then you look at this run that goes from 1,400 up to 2,800. So you got 1,400 points. Half of that would be 700 points. Okay, 50%. Anything less than 50% is considered a bullish pullback. So if you have a pullback of, let's say, 30%, this is 1,400 points. That's going to be about 430 points. Okay. That would take us down to around here. So either this one or this one, either one of these two pullback points would be good places to look for a bullish reversal on the long-term trend. This would be down in that range of about plus or minus 30%. That would be a strong bullish retracement. And either one of these points right here could serve as a 30% retracement. But if it follows the pattern, the long-term trend that it's in now, it will gap up from here, or not necessarily a big gap, but it'll trade up. And if it does, the target will be come up here and try to take out 2,900. All right. But the turns, the reversals, all of these are driven by news, by volume, and by traders changing the balance, the buying pressure increasing, the selling pressure increasing. The last thing that I want to impress on your minds is that whenever you target, and I'm going to go to a blank slide here, right here. Whenever you target, in other words, traders that have seen this kind of pattern, when the stock starts to move up, there is targeting going on. There's anticipation. It's because of history and it's because of emotion. At this point and this point, there was crocodile tears and there was jubilation at the same point. Some people were jubilant, others were devastated. Okay? Both of them remember, whether you were happy or sad, this price point means something. This price point means something. In between doesn't mean much. It's just a journey heading towards one of these ports, and there is emotion tied up and anticipation at both of them. These become self-fulfilling prophecies. So why do patterns have a tendency to go 3 to 5 times? Well, because once you've seen this once, twice, and 3 times, then people start anticipating this. And this will be either anticipated by starting it sooner in anticipation or pushing through. And then the patterns break. And then people start looking for something else, another, from a targeting standpoint, something else. So there is this element of it that is the motivation behind the trading pressure, is then trying to anticipate. Is you've got the front runners, the people that try to lead the pack, the people that try to manipulate the turns. That will then become a function of anticipation in the market. Once, twice, 3, 4, 5, and then it breaks. That's a very normal cycle. 1, 2, 3, and breakdown. That's a normal cycle. Once you get in this range of 3 to 5, that's about as long, either up or down. That's about as long as you can sustain that without it getting too anticipated and the rhythm is broken and the pressure builds up too soon or too late and the pattern breaks down. Okay, so I've layered things on top of each other. What we talked about in terms of indicators ties in exactly with trying to read chart patterns and anticipate turns. You could do it without indicators just by visually looking at patterns. But I think you can enhance that by adding indicators and pattern trading together. Guys, I think that when you learn to blend the different tools, you'll find yourself more comfortable, but hopefully more and more neutral. You have to always remember you have no control over what is happening in the market, none at all. You have to learn how to be good reactionaries, good reflex. You follow the momentum, you anticipate the tell, You see the potential target coming up before it gets there, and you ease up on the wheel or the grip so that you're ready to move, or you start pulling profits out ahead of that move. Guys, it's always, whenever you are wondering, should I get out or should I stay in, a subject for another class, and I'm going to teach the next one will probably be this one, and that is, should I get in or should I get out? And the answer would be, anybody? It depends. I'll accept it depends, but it's not what I'm looking for. I accept Robert's answer, which is yes. Helen says maybe. Nope. I'm fishing for something, and some of you have heard this in the past. Most of you haven't, so you wouldn't get it. That's fine. Should I get in or should I get out? And the answer can be both. You shouldn't have to be stuck twisting on that stick, straddling that sharp fence, thinking that you have to be on one side or be on the other side. What if you're in a winning trade? It's been positive. It's making money for you. And now you're not sure if you should stay in or get out. If you're not sure, that means there's a case to be made both ways. So do both. Brenda says, listen with your eyes. Bless you, Brenda. She remembered. You guys, Brenda, you cannot say a nicer thing to a coach or a trainer than to remember something that was important, that they thought was important, that they trained you or taught you, and you remembered it. That just makes them feel like they had a reason for living. Thanks, guys. We're out of time. God bless. Have yourself a wonderful, wonderful weekend. And I can't wait to chat with you next time around. Thanks, Will. Appreciate it. Thank you, Brenda. Thanks, everybody. God bless and see ya.